It's Friday, 26th of July, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the Bank of Japan. Will they hike again at their coming meeting? What's the impact of reduced bond purchases, and what's going on with the yen? But first, Neil, Shearing Group Chief Economist, joins me once again to run through a week in global macro gone by and peer into the distance of the trading days to come. Hi, Neil.
Hi, David.
So these are meant to be the dog days of summer. It should make us think of lazy days in the shade, but they really aren't, because the coming week is looking like one of the busiest we've seen in a long time in terms of market events. We've got Eurozone growth and inflation. We've got US payrolls coming. We've got Chinese PMI. We've got Australian quarterly CPI, the Bank of England, the Fed. I mean, I could go on, but enough to say we are not going to be bored in the coming trading days. So given all that's coming, let me ask you, what should we be paying most attention to in the coming week?
You're right, yes. Packed full week ahead. I think the place to focus really inevitably is the US. Not with the election, although I'm sure there'll be plenty more twists and turns over the coming days with regards to the election. But on the macro market front, a flurry of data and, of course, that Fed meeting. The context is concerns that the US economy is, of course, slowing. And the payroll stage at the end of the week, I think one of the key things to watch for there is what happens to the unemployment rate. Of course, we're quite close to triggering the SARM rule that has in the past signalled recession. So there'll be lots of focus there. Actually, the data has been a bit soft, but I don't think it's yet consistent with recession. So we had, over the past week, we've had GDP data, 2.8% annualized Q on Q in Q2, and consumption growth picking up. Actually, our GDP nowcast was pointed to 2.9% Q on Q annualized. So a bit of a win for us there and our new nowcasts, but it's not really consistent with an economy that's on the cusp of recession. So I think it's still a case of soft landing ahead of the US economy, but we'll get a bit more insight into that over the coming days.
Okay, a soft landing. We've had that strong, as you mentioned, that strong second quarter GDP number. From the Fed's perspective, how should they be jumping? There's talk of an urgency to act at this coming week's meeting and start the rate cutting cycle. Our view is that won't actually begin until the next meeting in September. Talk through how you think the Fed's going to approach it, given the flow of data that we've seen.
Well, the Fed's certainly going to be encouraged by some of the recent inflation data. We're talking on Friday. We've just had the core PCE numbers for June, and those showed core PCE prices up 0.18% month on month in June. They are up 0.1% in May. So we've now had 2 months of target consistent core PCE data. So the Fed will be encouraged by that. I think the other critical part to this, though, is how the real economy is faring. And as I say, the evidence over the past few months has been that the economy is slowing, but it's not collapsing. So although we've had Bill Dudley over the past week argue in his Bloomberg opinion piece that the Fed should start cutting interest rates this month, I think, as you suggest, the more likely outcome is that they will hold fire for this month, cut in September, and that would allow Powell to set the stage for a September rate cut when he speaks to the Jackson Hole Symposium in August.
Let's stay on central banks, because it is Bank of England week 2. As I said, a few months ago, we were thinking that this 1st of August meeting could mark the start of easing. Now we think it may be a bit of a non-event. What's changed, and what do you think we're going to get from this meeting, if not that first rate cut?
I think 2 things have changed for the Bank of England. The first is that the data from the real economy have been a bit stronger than was expected a few months ago. So, I mean, real signs now that the UK economy's picked up a bit of pace over the first half of the year. It's not going gangbusters, but it's certainly a lot stronger than it was at the back end of 2023. And the second point is that although the headline rate of inflation has come down, there's some signs that services inflation is proving stubbornly sticky. And I think that's a cause for concern for policymakers. So put all that together, I think that dashes any hope of a rate cut in August. But I think September's still on the cards, a bit like the Fed. I think a September move's more likely. All that means that perhaps the biggest event in UK macro over the coming week will be when Rachel Reeves gives her first speech to Parliament, makes her first statement to Parliament as the Chancellor of the Exchequer on Monday.
Yeah, and I know that's going to be the subject of your note this coming week, but give us your take on what you're expecting to hear in terms of the fiscal situation.
Well, the government's been laying it on pretty thick with the gloom around the economy since it's taken office. I think some of this is for political reasons. So we've had Rachel Reeves in various media interviews saying that she's been bequeathed the worst economic inheritance since the Second World War. I think that's overdoing it a bit, I have to say. But it seems pretty clear that they're trying to manage expectations in terms of both of the electorate that have obviously voted for change, but also for backbench MPs that are trying to make the case for additional spending in various areas. It feels to me that the stage is being set for Reeves to make a statement to Parliament in which he says, essentially, the public finances and the state of the public realm, the public services in the UK, are in a much worse state than we had thought. We need to raise taxes in order to plug a hole. And the numbers that have been talked about are somewhere in the kind of £20 billion range. Now, that will get the headlines. I think the really interesting question is, though, what does she say about the fiscal rules? These, of course, are supposed to anchor fiscal policy. And in the case of the UK, the government does not have much headroom against its fiscal rules, hence the need potentially to raise taxes. However, there's a possibility, I think, that she might decide to change the fiscal rules. And then, if not change the fiscal rules, then change the particular measure of public debt that is targeted as part of those rules. So there's various things that she could do, including, for example, excluding transfers to the Bank of England within that measure of public debt. That would give her a bit more room for manoeuvre. So lots of focus, I think, on what she has to say about the health of the public finances, possibly paving the way for tax increases. But I think potentially a smarter move would be to redesign the fiscal rules so it gives the government a bit more flexibility, doesn't box the government in, and it means it can delay difficult decisions on tax increases, because then if the economy continues to pick up pace, then they may potentially not be necessary.
Is there a similarity here with the UK's fiscal rules and Germany and its debt brake? Our colleague Francisca Palmers has had a report out this past week, which is looking at the debt brake, and she basically makes the case that there's this fiscal rule for Germany that limits the federal budget deficit, and that it basically amounts to just a massive act of economic self-harm by Berlin. Now, we're always talking on this podcast, aren't we, about DM economies being on unsustainable fiscal pathways and the risks that some of them run in eventually clashing with bond markets. Is there an associated danger here of going too far to impose fiscal discipline with badly designed rules that end up being counterproductive?
Well, I think the first thing to say is that clearly, as you suggest, that the fiscal positions of the UK and Germany are very different. The state of the UK's public finances, I don't think is quite as bad as Rachel Reeves has suggested in recent days, but clearly Germany's fiscal position is much, much stronger. So Germany's in a much better position. But I think that the common thread here is, as you suggest, badly designed fiscal rules, and in particular, fiscal rules that are too rigid, that don't allow much flexibility. The whole purpose of fiscal rules is to persuade bond markets in the case of the UK and the wider German public in the case of Germany of the government's commitment to fiscal rectitude. But if they're too rigid, then they end up boxing governments in and means that they don't have any flexibility to act in the economy's best interest. So in the case of Germany, yes, it would make sense to allow the government room to, for example, borrow to invest in a capital stock that is starting to crumble in parts. In the case of the UK, the crazy thing is that the government's primary fiscal rule is that public debt as a share of national output must be falling between the fourth and fifth years of the forecast. I mean, this is nonsense. These forecasts are subject to huge amounts of uncertainty that far ahead. And it means that the government becomes hostage to small changes in forecasts for GDP, inflation, interest rates, whatever, 3, 4, 5 years ahead, and has to start to act on fiscal policy now as a result, which is madness. So the fiscal positions of the UK and Germany are in very, very different places, but the common thread here is badly designed fiscal rules. And the solution, I think, is to have a set of fiscal rules that anchor fiscal policy, but give the government some room for manoeuvre and embed some flexibility.
Okay, I can't let you go without asking about China. If you look at how Chinese stocks and bonds have traded this past week, you really would be hard-pressed to see any evidence of surprise policy easing by the PBOC. But we have had some key rates that the bank sets cut over the past few days. Not by much, but just the fact that they're doing so is quite telling, isn't it? But the market's just basically shrugged its shoulders. And I wonder, coming out of the third plenum, which as we'd expected didn't really change the long-term narrative for China, that, in terms of catalysts for good news, there doesn't seem to be much around at the moment. And actually, that's even before we consider what a potential Trump re-election could mean, right?
Yes, I mean, just on interest rates, I think there seems to have been a shift in thinking in policymaking circles around the need to give greater support to the economy in the near term. So, as you say, we've had cuts to the 7-day reverse repo rate over the past week. We've had cuts to the loan prime rate, the 1-year, 5-year loan prime rate. And then we've had a surprise cut to the 1-year MLF rate over the past week. Interestingly, that was bigger. There's 20 basis points cut. It's not going to really make a great deal of difference. But that's larger than the 10 basis points that they normally move in. And the timing of the cut came at the end of the month. Normally, they would wait to the middle of the month to move on the MLF rate. But the fact that they've not waited till the middle of August, they've done it at the end of July, suggests there might be a recognition of a need for swifter action. So I think there has been a shift in thinking within Chinese policymaking circles around the need to give greater support to the economy in the near term. But as you say, I don't think it's going to really move the dial a great deal. These are small rate cuts. Yes, the PBOC is no longer boxed in so much on the renminbi, given if the Fed starts to cut rates over the second half of this year, then that will allow the PBOC to loosen policy too without putting downward pressure on the currency, which has been a concern. But of course, the other perennial concern is financial stability, large debt burden in China, and the desire not to stoke renewed credit bubbles by loosening monetary policy excessively. So there's not much room for maneuver on monetary policy. I don't think it's going to do a great deal to get growth going. It will help, and our forecast for GDP growth remain above consensus for China this year. But as you say, structural headwinds are the key issue here. And that means that potential growth, I think, still on the declining path. It will remain on the declining path. And that won't be addressed by small tweaks to interest rates. It requires more wholesale root and branch reform of the economy. We didn't get that. We didn't get any sense that was happening from the statements around and the documents around the third plenum, and I just don't think it's on the cards.
Neil Shearing on a very busy week ahead for markets. Our website's where you'll find all our previews of the releases and of the meetings. I'll add our Fed Watch and BOE Watch to the podcast notes. That US GDP Nowcast that Neil mentioned can be found in Data Explorer. It's our new home for all our interactive dashboards, which visualize our prop data and forecasts, coupled with thousands of historical series. We've also got new integration services to plug that data directly into your workflow, or even have the team prepare specific charts or chart packs for you. Find out more about how our data can help you at capitaleconomic.com/data. I'm also going to add a couple of notable reports from the team from this past week to the podcast notes. There's one looking at all of this talk in the market about a rotation into small cap stocks. We show why we don't think this is setting the stage for something bigger. Chief Markets Economist John Higgins, who wrote the report, will be on a drop-in. That's one of our short-form online briefing on August 7th to talk about that report. You can ask him your questions. Look out for details of that event. I also want to highlight that report that Neil and I discussed by our colleague Franziska Palmas about Germany's debt brake. It really underlines why Berlin's refusal to loosen this fiscal straitjacket has negative domestic, regional and global implications, so well worth reading. So the coming week, on Thursday, right after the Bank of England decision, that our senior economist team is going to be doing a drop-in on the latest Fed and Bank of England decisions, but also updating on the ECB in light of that meeting a couple weeks back. Before that, on Wednesday, there's another drop-in, which is all about the latest Australian quarterly CPI report. Some think it's going to be enough to push the RBA to hike at its August meeting. We don't. You can tune into that at 4 p.m. Sydney time, that's 2 p.m. Singapore, and you'll be able to ask the team your questions, hear about their response to the latest inflation data and what it means for the RBA meeting that's happening the following week. Asia Pacific head Marcel Thieliant and Tom Mathews, our head of markets for the Asia region, will be on that call. They're also going to be briefing later on Wednesday about the Bank of Japan's latest meeting. The bank raised rates for the first time in 17 years back in March. We think there's a case for another move at this meeting. Marcel and Tom spoke earlier in the week and ran through their reasoning. They also talked about cuts to the BOJ's monthly bond purchases, the outlook for the yen, and much more besides. Here's that conversation now, and it starts with Marcel talking about whether the yen's weakness of recent months has caused any concern for the bank's policy setters.
Well, the yen is now slightly stronger than it was around the time of the bank's June meeting, so maybe those concerns might have eased a little bit. It's also the case that import prices are currently rising by around 10%, which is a far cry from the 50% increases that we saw in 2022. So back then the yen was weakening more sharply, and also there was this surge in commodity prices in the wake of the Ukraine war, which is not the case today. So on past form, a 10% rise in import prices is not consistent with very strong goods inflation in Japan. But what we've seen recently is that producer prices of manufactured goods are actually still rising very strongly. And one reason might be that it's a delayed pass-through of the previous huge import cost shock. Import costs basically doubled between 2020 and 2022, and they've barely fallen since then. Another explanation might be that manufacturing firms started to respond to those strong wage hikes that are now happening in Japan. Whatever the cause, it's pretty clear that goods inflation will remain quite strong. So the Bank of Japan's latest Tankan survey suggests that manufacturers are actually now increasing output prices at a faster pace than they did earlier this year again. And the bank has also been arguing that the firms are now more likely to pass on any input cost increases to the output prices faster than in the past. So the bank is clearly worried. At the same time, we've seen service inflation slowing since last year. Now, we don't know what the bank had expected for those prices when they made its last round of forecasts. That by itself would point to some downward revisions to its forecast. But it has been arguing that firms are now more likely to pass on labor cost increases to their output prices as well. So the net effect is probably going to be that the bank will keep its inflation forecast broadly unchanged. And as a reminder, the bank has been forecasting that underlying inflation will be around its 2% target over the next couple of years, and actually surpass that target ever so slightly in the final year of its projection period. And it has been arguing that this alone, just meeting its inflation target rather than any overshooting of it, would result in a further tightening of monetary policy.
Okay, well, yeah, it's interesting then that given all that, most economists don't seem to expect the bank to raise rates at the upcoming meeting. So why do we?
Some board members have been arguing that its consumption is still too weak to warrant a rate hike. And I think those concerns are probably valid. We probably did see a bit of a rebound in consumption last quarter, but it was falling for 4 consecutive quarters before that. And real wages are still falling. So there's a question of whether the economy is really strong enough to warrant another rate hike. But again, the bank has been arguing that it needs to tighten monetary policy gradually over the coming years because the current stance of monetary policy is very loose. In real terms, the real policy rate is now, depending on how you measure it, is -2%, -3%. So monetary policy extremely loose. And if inflation is broadly evolving in line with the bank's projections, so there is a case for tightening policy further. Obviously, it's unclear when exactly the Bank of Japan will decide how fast they wanted to proceed with that tightening. There's clearly a case for another rate hike at this meeting, and we think the bank will press ahead with one.
Okay, interesting. And the bank's also pledged to reduce its JGB purchases. What can we expect there, if anything?
Yeah, so the bank held meetings with market participants earlier this month, and it's published a summary of those meetings last week. And as you could expect, there's a wide range of views among market participants. So some think that the bank should slash its bond purchase to zero, whereas other think it should only make a tiny reduction now and then wait for how markets respond before deciding with any further reductions. Now, we think that they will probably announce an initial reduction to around 5 trillion. Over the last month, they've been buying 5.7 trillion in JGBs. So a small reduction initially, but we think they will announce a gradual decline in those purchases over the next couple of years, perhaps to around 2 trillion. We've previously estimated that even if the bank were to slash its purchases to zero immediately, it would take almost a decade for the balance sheet to return to normal levels, so to speak. So clearly, that gradual pace of reduction means that any rundown in the bank's balance sheet will be very slow and incremental. It's unlikely that there's going to be any outright bond sales. But we've already seen quite a strong rise in the 10-year JGB yield in recent months, and it's now trading above 1% for the first time in more than a decade. Do you think that the slashing of bond purchases will lift it further?
No, I don't think so. It is hard to say. To be honest, we're a little bit in uncharted territory with how big the Bank of Japan's balance sheet really is, even compared to some of the other swollen central bank balance sheets we've seen over the past decade. But There's a couple of reasons. I mean, the first is you look at the global evidence of other central banks that have slowed their purchases or even sent them into reverse. You don't typically see huge rises in yields. And where you have, often those central banks have, started to wind back the programs of quantitative tightening or, essentially attempted to stop market conditions from deteriorating. So I think we'd probably expect to see something like that in Japan as well. If things really started deteriorating, maybe they'd change tack. But the reality is that, small reductions in purchases like the ones that you described there probably aren't going to be particularly disruptive to the market or send yields shooting high if the international experience is anything to go by. I think the second thing to note is, as I said, the stock of their bond holdings is still really big, right? Even if their purchases went to zero or even if they started selling bonds into the market, they still have this huge share of ownership of the market that really, I think, is probably bearing down on yields and is going to continue to do so for quite a long time. So those are reasons, I think, to think that really what matters for JGB yields and to be honest, probably what's been driving them up since the end of YCC is the expectations for what they're going to do at the front end, whether they hike at this upcoming meeting and whether they're going to continue to hike or not. That's really, I think, what's going to be the driving force rather than whatever they're doing with the balance sheet, which based on the sort of likely plan seems like more of a sideshow at the moment.
So we've all seen this FX intervention by the authorities a couple of weeks ago. And we've been arguing that FX intervention is merely a stopgap solution until the Federal Reserve starts to ease policy. But you've mentioned that it's now looking more likely that the Fed will finally start its easing cycle. So does that mean that we can finally see a sustained rebound in the yen?
Look, I think so, and certainly that's our base case forecast. But it has been a challenging one to predict over the past few months, for sure. I think we'd been arguing for a while that weakness in the yen was really reflective of yield gaps between Japan and the US. And once the yield gap started to move in its favor, you'd start to see a bit of a rebound in the yen. And we did see that yield gap start to move in the yen's favor, probably starting maybe late April, and it's continued to do so. And yet, of course, until recently, the yen continued to weaken. And I think that's probably partly what's prompted the ministry and the bank to step in with that intervention was maybe a sense that there was some large positioning in the market, some shorts, that it wasn't really responding to market conditions in a way that it had over the past couple of years. And perhaps this was an opportunity to squeeze some of that short positioning out of the market. And of course, we have seen the yen rebound quite a bit more recently. Having said that, there's still a very large gap between where the yen is now and where the yield gap would suggest it to be relative to, let's say, the US dollar. I think if you were solely basing it on, let's say, the 10-year yield spread, you'd expect the yen to be closer to 135 than 155 where it is now. So, at face value, I think there's probably a fair bit more for it to go. The other point to note on the yen is that it's just historically cheap on any other metric as well, the real effective exchange rate. Now, that's one that's, of course, been declining for a while, but it's basically now the cheapest it's been since the currency was floated. And all the other sort of valuation metrics that we look at, I think the yen looks very cheap. I'd expect it to continue to rally, but I expected it to continue to rally at the start of the year as well, and that didn't really happen. So as I say, it's been a hard one to predict. Our base case remains that it looks weak, and its recent rally should be the start of something a bit more sustained.
We've also written a piece together about a year ago where we argued that the outperformance of Japanese equities won't be sustained. We've explained that partly by expecting the yen to strengthen with it, which in the end it didn't until quite recently. But Japanese equities have nonetheless started to underperform US equities recently. Do you think that will continue?
Yeah, as you say, I think the currency actually has a big bearing on this. And I'd think about it in a couple of ways, the performance of Japanese equities. The first is in yen terms, the local currency indices like the TOPIX, the ones that everyone watches. I think a huge amount of their strength relative to indices overseas has just been the weakness in the yen. So it's not really surprising that as that yen has started to turn, that maybe they've come under a bit of additional pressure relative to markets elsewhere. And if we're right that the yen is going to continue to rally, then you'd expect topics to remain under pressure and perhaps even fall outright, I think, after what has been a pretty sustained period of good performance. But perhaps of interest to global investors isn't just the performance in yen terms, but the performance in dollar terms, because a lot of that over the past couple of years has actually been a wash. You see a weaker yen and then you see a stronger topics, and it sort of balances out when you're thinking about these things measured in common currency terms. And I think the interesting thing to note there is that actually until the last couple of weeks, it actually had started to perform quite poorly in dollar terms as well. I don't think that'll last. I think the Japanese market does have some things going for it, particularly its perceived closeness with AI technology or with sort of technology more broadly in the midst of what seems to be a fairly broad tech rally, at least until quite recently. I think that'll continue. I don't think it's going to do as well as, let's say, the S&P 500 or anything like that, but it might continue to hold up reasonably well in dollar terms. In a world where you're probably getting pretty poor yen return, a rally in the yen, I think overall returns from Japanese equities will be okay in that sort of environment.
That was Tom Mathews and Marcel Thieliant on the yen, Japanese inflation, and the BOJ response. As a reminder, they're doing 2 drop-ins on Wednesday. First on Australia's quarterly CPI report and what that means for the RBA's August meeting. And then after that at 9 a.m. London, that's 5 p.m. Tokyo, they're talking about what the BOJ did at its meeting and the future of Japanese monetary policy making, the yen, and much more besides. As with all of our drop-ins, if the timing doesn't work for you, register anyway, and you'll get a recording in your inbox once it's concluded. You can get details of all of our upcoming drop-ins and watch recordings of previous sessions on our events page. That's capitaleconomics.com/events. I'll be back next week with Neil to run through the outcome of that very busy calendar of events. Don't forget you can find all of our previews and responses to market events on our website, capitaleconomics.com. But until next time, goodbye.
Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.